Hey, good evening, everyone. Marty Missouri here, the 7th of October, 2022, with your weekly economic update. Already did the stock market snapshot for you. So this one should be a little shorter than usual, except I do want to spend just a minute or so on inflation and also on sentiment around the stock market. In front of you is our PWA index. Came in this week at 8.89, which was down about 6 points, actually. Doesn't surprise me as I saw the data roll in during the week. Our handful of inputs are for this week. Mortgage purchase applications come out weekly, down a bunch again, so not a good look for the housing market. Of course, you can blame this one right now on mortgage rates north of 6%. Probably not much more needs to be said than that, frankly. Initial jobless claims had been really doing well. They were down like, I don't know, 8 or 9 weeks in a row. They actually took a pretty good pop this week to the upside to 219,000. We also, can't see it here, we also ticked up a little bit on the continuing claims. However, the payrolls report, non-farm payrolls, actually came in a little better than expected. It was down from the previous month, but up 8,000 versus expectations. The unemployment rate dropped to 3.5, but that probably has to do with a slight drop in the labor force participation rate, people actually walking away from the labor market or the workforce. Average hourly earnings up 5%. The quits rate, 2.7%, stayed flat over month. The job openings dropped to 10 million, and that was, I think, the biggest 1 month drop in history, although still very elevated historically speaking. I mentioned the labor force participation rate coming down a smidge, and the U6 unemployment rate staying pretty steady at 6.7, and that just captures disenchanted workers, folks who would like to work full-time but only work part-time and so on. So yeah, it was better than anticipated. It was enough today to roil markets a bit from the start, but then when Fed speakers started talking, pretty much all she wrote. In the earlier video, that we also hit some key levels that have to do with dealer hedging, that if we hit through that, came through that, according to our experts, would precipitate a fall to around 3,600 on the S&P. And we closed just a bit above that. The S&P today closed at 3639. We were down a little bit more than that at the lows of the day. The ISM Purchasing Manager surveys, the services came down a little bit, but it was still better than expectations and is safely above recessionary conditions, which is 50. Below 50 denotes contraction versus the prior month. So decent look in the services. Looking through the details, looked okay as well. Manufacturing, however, continues to plummet, not quite contracting month over month, but getting pretty close at 50.9. Global PMI, JP Morgan does this Global Purchasing Managers Index. Looking at it country by country, not so good. It does look a little better on a month-over-month basis here in the aggregate, but still contractionary, below 50. There you have it, just a handful of our inputs. I mentioned I want to touch just a minute on inflation. Got the CPI coming out next Thursday. The market will move on that number, I can assure you. It will move, I would suggest that it'll move down. If the number is the least bit hot, it would probably rally if it comes in cool. Time will tell. Wanted to talk about cost of shipping, and there's a Cass Freight Index, of course, which we feature in our index each month, but until that comes out, we're looking at things like the price to ship a 40-foot container from Shanghai to LA is rolling over hard, folks, very hard. So that's encouraging, right, from an inflationary standpoint, presumably. However, it's still historically very expensive, right, to ship, but way off of where we were. CPI has a transportation component, the sub-index. Used cars, used trucks are in there. Manheim provides data on used vehicle pricing, and here you can see that rolling over quite dramatically as well. Still high, but we're looking for changes in direction and then the rate of change in that direction. And encouraging stuff, I would say, when we get to these inflation prints. Is it going to come in soft next Thursday? I'm certainly not betting on that. But over time, we do believe that inflation overall, I guess, in the aggregate has peaked. That said, wage increases, right, are very, very sticky, for one example. And as we've stated for the last 2+ years, we are in that structurally higher for longer inflation camp. 8-9% prints, no. Rolling over and moving in the direction of the Fed's 2% target, yes. If it accelerates and it's encouraging, will the Fed back off? Of course, despite what they're telling us in the meantime. Okay, so in just a minute on sentiment. So we have what we call the PWA Fear Greed Index, and it scores right now, folks, a 78. 100 is the highest fear score, so 78 is getting really, really close. One component that I wanted to show you before I let you go tonight is the advisor sentiment survey weekly from Investor Intelligence. I'm just pulling that page over. The bull-bear spread, and the name, of course, speaks for itself, the difference between bulls and bears in their survey, is a negative 16.4. So 16.4% more bears than bulls, and that's up a bit from that 8.9% difference a week ago. Third consecutive negative spread. Those types of readings were also shown early last summer, just below the 17.6 reading at the mid-June bottom, right? Remember, we were pointing big time to sentiment. That signaled lower risk to buy, and it turned out to be a good trade anyway. The March 2020 lows, right, which were definitive lows, we came out of those very strongly. It was at a minus 11.6, and it's more than that today. And then just skipping down to their chart here, we're below the level we were when the market bottomed here in March of 2020, right, as I just read to you up there. And then that nearly 20% steep correction in the fourth quarter of 2018, you can see how bearish advisors got there. And then more recently, and again, here's that, that essentially that June bottom point here is we're starting to get a contrarian buy signal in there. We still have a lower price target than we are right here, but we do think the values are emerging. And if we're smart and we don't try to catch the bottom, essentially we want to catch good values today relative to where we think values are going. Obviously, should go without saying. Could we catch another pop? I would say highly likely. Am I trying to time that? No. Next week we have that CPI number. As I said, we will get some movement from there. If we go in there with a high deal of pessimism and you get any kind of relief in that number, then of course that could get things off and running to the upside as well. Folks, thank you as always for watching and listening, and I'll talk to you next week. Take care. Bye-bye.